Hello, everyone. Thank you for joining us today for the Economist webinar on the $50 trillion question, closing the emerging markets capital gap, supported by Standard Chartered. A little bit of context here. Standard Chartered has spent the last year speaking to a panel of the world's top 300 investment firms with total assets under management of more than $50 trillion, which is more than half of global GDP. The goal of that survey was to find out if investment is going where it matters most. It launched the findings from this survey in November, and today we're picking up the discussion to explore these themes and understand whether investors are using their assets to support sustainable development goals and examine how they can drive sustainable investment to help build a better future for the planet. Without further ado, please join me in welcoming our panelists. First up, we have Daniel Hanna, who is the Global Head of Sustainable Finance at Standard Chartered. Welcome, Daniel. We also have Andrew Howard, who is the Global Head of Sustainable Investment at Schroders. We are further joined by Nasser Saidi, the President of Nasser Saidi and Associates, an economics consulting firm. We also have Karen Finkelstein, the Vice President of Partnerships, Communication and Outreach at the International Finance Corporation. And lastly, we are joined by Thomas Fekete, the Head of Sustainable Investment Solutions for EMEA and APAC at BlackRock. So 5 very well positioned and powerful speakers have joined us on this panel today. I'm delighted in sort of having the opportunity to discuss these questions with them all. Just to set the scene a little, the discussion that we're going to sort of have today will focus on how it's increasingly becoming the norm for investors to have to consider the environment and social governance, the impact that their investments have on those goals alongside financial returns. Initiatives like the UN's Principle for Responsible Investing govern more assets than before, and there is increasing activity through initiatives like social bond issuance, which leapt in 2020. The implications could be significant. Sustainable finance is a necessary puzzle piece in the ability of nations to meet the 2030 agenda, and the Paris Agreement. There was a huge need for energy investment in poor countries. There was a huge amount of capital in rich world pension funds. At the moment, though, there is trouble squaring funds' appetite for safe and reliable investments and the risky zero-carbon energy investments available in developing countries. This is the basis for the $50 trillion question Standard Chartered have posed. Can we allocate enough capital to sustainable projects in emerging markets to make an impact on decarbonising? So my first question I will pose to all the panelists in turn, which is, firstly, could you explain a little bit about who you are and your role in your various institutions, and what is your sort of starting stance on this question? What is your firm doing for sustainable finance in emerging markets already? I'll go to Daniel first.
Great. No, thank you, Alice. And it's a real pleasure to be here with such an impressive panel. So I'm the head of sustainable finance for Standard Chartered, which is a British bank, British headquartered bank with over 150 years of experience in the emerging markets, specifically around Asia, Africa, and the Middle East. And I think my job, but actually I think the whole firm, is very focused on driving sustainable finance, as you said, to where it really matters. And I think the growth of sustainable finance, in fact, the record-breaking growth of sustainable finance this year has probably been one of the few bright spots in quite a tough year for everybody. And as you sort of talked about, one of the key levers, I think, frankly, for the planet to achieve the Paris Agreement of not keeping global warming significantly above 1.5 degrees, moving towards net zero and achieving the UN Sustainable Development Goals is really going to be Asia and the other emerging markets over this next decade, what the UN Secretary General calls the decade of delivery. And we feel that Standard Chartered is uniquely well placed to help catalyze the necessary investment and capital flows required to transition to a low carbon business model and support the growth of sustainable jobs and sustainable growth in emerging markets. And it's these emerging markets that face the biggest risk from climate change and also have the biggest opportunity to leapfrog to low carbon technologies. But the reality, I think, is the capital is really not flowing there at the moment. And you referred to the $50 trillion survey that we've done with the world's biggest asset managers. And I think the good news is that survey shows that almost all investors who are aware of the Sustainable Development Goals plan to increase their Sustainable Development Goal linked investments between now and 2030. The bad news is that only 13% of the people we asked had assets under management currently linked to the Sustainable Development Goals. And even worse, 1/5 of investors weren't even aware of what the SDGs were and how it was going to link to investments. So I think how we catalyze this capital to really start investing at scale in emerging markets is a collective challenge that we're really passionately focused on. And I'm sure that the panel will sort of dig into and how we can do it.
Great. I will just go along the participants as they appear in the order on my screen. So let's go to NASA next. NASA, I think you might be on mute.
Right. Thank you. Thank you for reminding me. My name is Nasser Saidi. I'm an economist, as you noted, but I'm here as the chair of the Clean Energy Business Council in MENA. What we do is we support clean energy and clean technology across the region. And the MENA region is particularly important because it's highly vulnerable to climate risk, both because you've got desertic climates and they're growing, but also there's a great deal of water shortage. And at the same time, what's interesting is the particular challenge posed to governments in the region. They have plentiful fossil fuel resources. So part of the message to them is a difficult message of saying, well, you're going to have to reduce your dependence on fossil fuels and your use in all economic activities and in terms of government revenue. So part of what I do, I advise governments across the region, is also to try to get them to start imposing climate change policies across their national oil companies and in terms of the private sector. And as well, trying to develop the bond markets, the green bond markets, the green sukuk markets. That's a major thing that we do with many of our partners in the Clean Energy Business Council. And just to remind ourselves, if you look at the growth of sustainable finance, yes, we can applaud ourselves that it's the fastest growing segment. But if you look at green bonds, they're still only 5% of total global bond financing. And in the region itself, that's less than 5% as well. So there's a long way to go in terms of what needs to be done. So I would just stop there by saying that one of the things that I'm aiming for is that the governments of the region start national climate assessment strategies and then national climate adaptation plans. That's number one on my agenda. And from that, of course, falls a number of recommendations for economic policy, for monetary policy, fiscal policy, the role of capital markets, and as well, how do you bring in the private sector into that? What role for corporate finance, and how do you integrate that into the financial system in the region and globally?
Great, thank you for that sort of sweeping perspective. Why don't we pose the same question to you, Karen, next?
Great, thanks, Alice, and thanks for hosting this panel to The Economist and Standard Chartered. I'm the Vice President for Partnerships at IFC, as you mentioned, and what my role is really trying to build partnerships that help us deliver more sustainable finance and balanced with creating jobs and improving livelihoods across the emerging markets. IFC was founded over 60 years ago with just this purpose, which was really to demonstrate and mobilize the private sector into emerging markets to solve development challenges. I think as Nasser and Daniel both mentioned, this boom in ESG financing or sustainable finance has been something that we've been following for, I think, over a decade. We issued we crossed the $10 billion mark in terms of our own green bond issuance, and that leads to channeling that funding into sustainable projects across the emerging markets. And we've also been following sustainable bonds and blue bonds now. We issued a bond recently in Asia around plastic recycling with Indorama Ventures, which will lead to a significant increase in recycling of plastic. from one of the plastic makers, Indorama. I think when we look to the future, we see this COVID moment as something that is really sending a huge message about how we need to start channeling some of this $50 trillion that's out in the markets into how we solve development challenges in emerging markets. So we're really working across, whether it's upstream on the policy side to help reform some of the markets so that we can really, as the panel's title says, get the money where it's needed most. So thank you.
Great, thank you so much, Karen. And why don't we go to Thomas now? Again, Thomas, I think you might be on mute.
Sorry, yeah.
No worries.
I was on mute, but I was not conscious of it and struggling with my mouse. So good afternoon and good morning, everyone, wherever you are. And thank you for having us. It is a crucial problem we're talking about today. So I run sustainable investment solutions at BlackRock for our European and our Asian clients. That means helping our clients have portfolios that are supportive of sustainability. It is a demand from our clients, but it's also a conviction from our firm. So it's about reorganizing and changing processes and introducing a lot more information into the investment processes that was not considered, let's say, 10 years ago. It's made its way up through the last decade around the environment, around social, and around governance. And I think in emerging markets, the are actually very relevant. When I heard my other panelists so far, so many topics that we could really focus on vis-a-vis emerging markets. One is the Paris alignment, the fight against climate change, which is so urgent globally. So there's no choice around it. We have to push in that direction. And yes, the emerging market economies, some of them are growing much faster than the developed ones, and they need energy, and we need to help that transition. And as was discussed at the Paris Agreement, the COP25, the concept of a just transition is paramount, right? We cannot block or cap the growth of emerging markets because we need to solve a global problem. So there is an angle here that I'll be very happy to discuss about how Western world investors can actually help bring capital to emerging markets. I would just make that remark first, that emerging markets in the financial jargon is probably not exactly what we want to describe, but maybe much more what Karen is referring to with developing markets from an economic development markets. Because if you think about emerging markets, China is an emerging market pedantically, and it's close to being the number one economy in the world. So I think we're talking about countries which are accelerating on the economic path. So one aspect is definitely decarbonization, energy transition. And the second one is probably a little bit more social and related to the UN Sustainable Development Goals, right? And helping the fight against poverty, among other things, and education, health, etc. That is also where capital needs to be channeled. And I think when we look at the spectrum of all sustainable investing, each of these topics can be addressed, but it's hard to address them all at once. So I think offering a pretty clear categorization of options to our investors is important, and we can talk about that as well.
Wonderful. Thank you very much, Thomas. And last, but certainly not least, we have Andy Howard.
Great. Thank you. So I'm the Global Head of Sustainable Investment at Schroders, which basically means being responsible for the sustainable investment strategy across the roughly £500 billion or so of assets that Schroders has under management, which is spread across all geographies of the world, spread across different kinds of asset classes, both public and private. But I think one thing that is clear is that sustainability has long been something that we have looked at, but really over the last few years, there's been a real acceleration in how we're looking to embed that, not just in particular areas of the firm, but across the organization. So a few observations now. I'm trying quite hard not to echo a number of the things that Thomas has just mentioned, but firstly, we created a partnership with an organization called Blue Orchard, which is a microfinance institution about 18 months ago. focus very much on sort of, if you like, the most obvious and clear areas of development need in many emerging markets. I think that in one sense is the sort of solution that's needed, but actually where the real focus is on how do we move the other 498 billion of assets that we're managing in a direction that is more closely aligned with and supportive of tackling sustainable investment goals. And I think for me, we often tend to think of this in terms of delineation, in terms of this bit of assets over here should be sustainable and this bit of assets over there, we don't need to worry about it so much, depending on preferences and so on. We think of it very much in terms of the whole. I think the thing that has particularly changed over the last few years is that whereas historically we thought about two different questions, one of them being there is a societal and environmental need to redirect capital to solutions that exists over here, and then there are finance and investment questions over here. Those two circles increasingly intersect. And I think certainly from our point of view, every investor has to be a sustainable investor. Every investor has to understand the implications of structural shifts in the world economy, industries, the value of their investments as a result of whether it's climate change or whether it's the spectrum of other challenges or trends that are outlined within the SDGs. And the growing focus that we're seeing globally amongst policymakers, amongst society, amongst corporates to trying to tackle those problems, the fact that they continue to stay firmly on the political and social agenda, despite everything that's happening with COVID and the crisis and everything else that's happening in the world, does, at least to us, imply that the prospects of huge amounts of capital being shifted in the economy are growing. We as investors have a major part to play in helping facilitate that transition. We also have a huge role to play in making sure that our investments are aligned to that transition, simply for the purposes of ensuring that the value of those investments is protected as it plays out. And I do think the fact that societal goals and financial risk and opportunity are increasingly becoming aligned as a result of greater policy focus, greater social focus, is probably one of the most important aspects, and ensuring that alignment becomes tighter still is one of the most important aspects towards deploying capital on the scale that's needed to tackle the challenges that we're facing. And that's certainly, in our mind, how I think we certainly have to think about this as something that applies across all of our organisation, frankly, all of capital markets, rather than something which exists in a vacuum or in isolation for specific strategies or specific funds.
That's wonderful. Thank you so much, Andy. A lot to chew over in all of the sort of cumulative insights in your sort of 5 opening sections. One thing that struck me while listening to you all is that there seemed to be a sort of vast and interesting range of tools that you could use to try and sort of boost sustainable finance. We've mentioned green bonds, we've mentioned sustainable development goal linked investments. Andy's just mentioned this idea of sort of sweeping all investments into a strategy or a vehicle that sort of acknowledges sustainable goals. We've also had a flavor of sort of moral suasion of governments and other world leaders, either through Paris agreements or, as sort of NASA was saying, through explaining that changing up their economies will ultimately be to their benefit. Obviously all of these tools are necessary, but I wonder whether there are any that sort of leap out at any of you as having been particularly successful or particularly interesting in terms of generating interest in or capital flowing towards sustainable investment. I don't know if anyone's desperate to go first on that question. If not, I'll probably pick on someone. Why don't we go to Daniel, because he had to go first last time. Whatever. Sorry? Oh, sure, Thomas.
I was just saying I'm happy to jump in, but Daniel, whichever.
Okay, I'll jump in. I don't mind, Thomas. If you want to go, I'll follow. That's right.
Okay, thank you. So I think the question I have, and that I'm trying to answer in the context of this panel, is how do we attract need that we've identified, right, in the emerging markets, in the developing nations? And I think there are 2 aspects to it. One, we need to make these projects or these companies attractive to investors. So let's think about that. And second, they are perceived, and it's kind of connected, they are perceived as quite risky. So how can we help also de-risk and or to give incentives to investors to direct capital there? I'm talking about the private capital as opposed to public money. So thinking about private capital, so an example that we are working on, which is a collaboration with many others, is the so-called climate finance partnership. So it's an example of this concept of finance called blended finance, where you bring together public and private. So here, we are leading the setup of a fund with the governments of France and Germany. And the idea is we want to invest only in emerging and developing nations to help them on the energy transition. And we pledge that 25% at least of the investments will go to Africa, and the rest of the 75% to emerging countries. But the problem is finding the investors. So having had the two governments step in and say, we're going to put each of us, and that will be kind of the first loss for investors. So private investors who come on top will be protected in a way by this capital provided by the governments. That is a mechanism that actually is very attractive to investors. It's also attractive to the governments. The way we're going to run the fund is not taking crazy risk either. We have experience. So BlackRock or others have experience in doing these types of projects. So it will lead hopefully a very good return. But there is this reassurance to private investors to attract a multiple of what the governments are putting into the fund. So that's one thing, one idea, one mechanism. The other aspect of the question in my mind is to convince investors that investing in emerging markets can further sustainability in these markets. We need to make sure that the companies that operate there also embrace. So we need to help the companies understand it's a complex ecosystem sustainability. There are lots of regulations, acronyms, organizations, and for whoever enters that sort of world, there's probably a 6 to 12 months learning curve about figuring out who does what and what are the standards. So our role as professional investors is also to help companies look the best they can to attract that capital. So we encounter a number of emerging market companies in countries like Brazil or Southeast Asia who are, in quotes, badly rated by MSCI, but it's mainly MSCI or others, right? Rating agencies on ESG. But it's very often for lack of having enough information available. And helping the companies understand what they need to show to be better perceived is the first step. It looks kind of cosmetic at once, but it's actually helping capital flow. So these are just two examples. There would be a much longer list I could go through, but I want to maybe pass on to some of my colleagues.
Great. Maybe, thank you, Thomas. I won't talk too much about blended finance because we've got Karen on the call, and she's an expert on this, so she'll talk a lot. But I definitely agree with Thomas's point that blended finance, I think, is one of the important tools. And I think basically we need to do three things. We need to catalyze, we need to standardize, and then we need to democratize. This is going to be at the heart of how we can drive sustainable finance to where it really matters. In terms of catalyzation, I think blended finance is one of those very important tools where you can encourage private sector investors who previously hadn't gone into the market through the sort of strategic use of development or other concessional capital. We've done $5 billion worth of blended finance transactions in emerging markets in the last 3 or 4 years, working with IFC and others. And as I say, I'll let Karen talk a little bit more about that. But I think the other two areas of catalyzation I think is really important is, one, we need the success of green bonds to go olive or multiple shades of green. We really need to develop this concept of transition finance. And that's our big area of focus in 2021 is how do we support brown companies become progressively greener? They can't really tap the green bond market at the moment, but if we can develop this as an asset class and actually get capital flowing into moving sort of brown industries into further green industries, I think that's going to be a really important tool. And I think particularly in emerging markets that has a concept. And the second thing is, if you like, is we need green to turn into a rainbow. So Karen mentioned blue bonds. We had the pleasure of working with the World Bank to do the first blue bond for the Republic of Seychelles. But we've also done gender bonds, and there's a variety of other kind of using capital markets again to tackle specific sustainable development goal areas. So I think, green going multiple shades or olive and green going into a rainbow are two big areas as well in terms of that catalyzation. The second is standardization. And here, frankly, I think the finance industry has not made it easy for investors or for anyone else because there is an alphabet soup of different definitions, categorizations around sustainable finance. And I think we did a survey earlier this year about what are the single biggest impediments for investors, private investors now, high net worth individuals and private investors coming into sustainable finance. And it was the lack of information and transparency on impact. And I think we need as an industry to effectively show that clarity and show that clear link to impact. Standardization is key. When the green bond principles were standardized, since then we've seen a 7-fold increase in green bonds. So we need a similar sort of rigor and transparency, which is why Standard Chartered has published its own framework linked to the Sustainable Development Goals, the EU Sustainable Taxonomy, and we publish an annual impact report that shows exactly the number of jobs created, the amount of CO2 saved, and a number of other stats to give that clarity. And then I think finally, this democratization. Funding is really not flowing to the countries that are at the greatest risk. And I think, as Thomas said, some of that is kind of at the investor end, and I think we need to do a better job of explaining that impact, as I said. So one stat from our impact report, which I think I'd love every investor to be aware of that's interested in sustainable finance, a single dollar invested into a solar project in India compared to the same solar project being created in France has a 7 times bigger impact in terms of climate change if it goes to India. So driving capital from Lyon to Lucknow is going to be a really key part of how the globe tackles climate change, not just how do we do it in emerging markets. And I think that's really important. On the other side, as Thomas said, we also need to make sure that companies are aware of the importance of ESG. And that's why we set up an ESG ESG advisory capacity within Standard Chartered to help our clients also start moving and thinking about how they engage investors in this kind of way. So catalyzation, standardization, and democratization.
Alice, maybe I can build on what Daniel said, if that's okay. I think, where we've been working is really looking, first, as I mentioned on the supply side, we have a overriding strategy called creating markets. And it's really around these two issues of financial return and what we call development impact. And we, as I said, we were founded over 60 years ago to basically demonstrate that you can have positive development impact while still making adequate returns. And I think on the supply side, as I noted, we're really scaling up our use of the bond markets, and we worked on the green bond principles, and we've been working creating funds. One is with Amundi to really support the development of emerging market banks to issue bonds that are green bonds so that they can start to use the proceeds of those bonds in projects in the emerging markets. And I think what's been interesting about that is we started to see whether it's Ecuador or Indonesia or the Philippines really being able to start being the first involved in the first green bond issuance in these markets. So really driving that supply of finance that's looking for green projects. I think what Daniel mentioned around the standards is really important. We issued operating principles for impact management. And what's really fascinating about that is we've got over 100 signatories to these standards. And it follows on from our development of what we called the Equator Principles, which we developed with commercial banks over 15 years ago. And I think what we're looking on the impact standards is really to say on these principles, how do we define impact, and how do we make sure that we're not creating impact washing, where we put impact into the title of different funds and people can't really be clear on what impact means. So that's something we're now working with private asset managers and asset owners. And the interesting thing is over 30% of the signatories signed up during COVID, which is fascinating because I think we're starting to see a real interest from the asset owners and where their money is being put to use in a time where we clearly need financial return, but we also need problems to be solved. And I think this leads to just the other side of our strategy, which is the sort of demand side for this sustainable finance. And this is really how do we develop bankable projects in the emerging markets that can actually take this financing in a viable way to solve the challenges that the countries are facing. And that's what I mentioned at the start around really starting with the governments on the policy reform, figuring out which sectors we think have the most potential to develop jobs, to support growth and solve these development challenges, and then working with governments to create the reforms that would allow the private sector to enter in a viable way. And then that comes to the de-risking that Daniel was talking about. Once we've got projects that are investable, then you obviously have to encourage the investors to come to put their money in a long-term way at risk in these markets. And that's where we've been working with our colleagues at the World Bank and created what we call a private sector window with IDA, which deals with the poorest countries globally, to really provide de-risking instruments to allow investors to come in and bridge that gap between perceived risks and actual risks, as well as the investors' return goals. I think what's really important there, though, is that we use these blended finance tools carefully, because we don't want to over blend with subsidized financing, because we're ultimately trying to create markets that will eventually support the economies in a market-based way without over-reliance on subsidy.
Alice, if I can come in at this stage, I mean, I'd like to take it up to a little bit of a higher ground at this level. We all agree, I think, that risk mitigation and risk sharing have got to be the basis for any market-based finance. And there are a number of interesting possibilities going from blended finance to other. But I think we need to go a bit deeper and agree that climate finance is really a global public good. And if we look at it from a global public good requirement, what we really need is a framework for risk sharing. And that has to start at the level of central banks, okay? Now, the network of central banks and supervisors now are starting to work at what they call greening the financial system. And I think that has to be our strongest approach. And the way that works is by first internalizing climate risk into financial regulation and supervision. That means we start looking at climate risk in terms of stress tests for the banking system. We're doing scenario analysis. That has got to be a starting point. The next point is, of course, prudential ratios, capital requirements, because once you do that, the financial system will start integrating the pricing of risk, climate risk, into loans, bonds, and everything else. I think we need that framework in order to move forward. Until you do that, it's going to be piecemeal. It's going to be piecemeal approaches. And if you're asking the private sector to do something, you need to integrate it into the accounting frameworks. So far, climate risk has not been well accounted for in either corporate accounting or international accounting. I think a major effort needs to be done there. So again, I think what the private sector needs is clear policy direction at the national level. That's why I think we need to start with climate risk assessments at the national level and then go down progressively. That creates a framework for alternative possibilities of different types of instruments that you might want to use. If I look at the region, and particularly emerging markets, there's one single thing that we need to focus on, and that has to be infrastructure finance. That has to come above all else at this stage. That means making sure that all infrastructure is climate resistant, climate resilient. And that means we want to orient as much as possible of finance to that. That means going into renewable energy, clean technology, clean cities, infrastructure investment, because that is the requirement for so many of the emerging markets, because their demographics are such, as I think Daniel was pointing out a bit earlier, their demand for energy is going to be skyrocketing in the years to come. If they continue on fossil fuel-based energy providers, then we're going to miss all the other goals that we're thinking of. So we've got to think of how do we finance infrastructure as being the prime thing above all else. And that means working with governments, but also the private sector. So PPP type approaches, I think, are going to be critical when we're dealing with emerging markets. And that calls for a different set of tools than what we've been talking about so far. Yes, various funds can help in going into PPP, but we need to think about how do we open up the markets. London Stock Exchange, for example, now has a bond market for sustainable bond market. That has attracted quite a bit of green bonds into there. We need to multiply those examples across the world and make it easy. But I think you need that overall regulatory framework and supervisory framework, which we're missing so far.
I was just going to pick up briefly on a couple of points. I would fully agree with a lot of those points that have been made. And I think one thing that I would add in is that when we talk about finance, it's a big and diverse area. And I think that point around infrastructure and PPP in particular, what we're talking about is fundamentally making capital available to the real world and real world solutions. And there is a challenge sometimes when we think about the majority of the financial industry is still focusing on publicly traded securities, whether they be equities, credits, or sovereign bonds. And it's about ensuring that we're connecting capital pools from savers or providers of capital through to real world solutions in a way that's meaningful, rather than simply thinking about buying the shares of one company or buying the shares of another company, which doesn't actually directly have an impact on those real world outcomes. And I do think it's important that we think about different kinds of solutions and think about how do we take the sorts of investments in infrastructure, which is very much a real world outcome, and connect that through to public markets and through to pools of private capital. And what are the hindrances to doing that? And to a large degree, I think there are challenges around liquidity. There is a perspective that real world investments by definition typically tend to be relatively illiquid. And there are challenges amongst a lot of the financial markets. And this is, if anything, grown really over the last 10, 20 years or so. An increased focus on the importance of liquidity has tended to make it more difficult for a lot of investors to invest in the sorts of infrastructure types of projects that NASA's outlined. And I think it also connects to the challenges around, the points around regulation, the points around kind of policy intervention are really important, and they are changing. So we're seeing it in many parts of the world, as I think there is a really big shift and a really important shift towards ensuring that financial risks from climate change, for example, and it is mostly climate change at the moment, are reflected in the way that risk is measured and the way that that's applied within for investors. But we should also recognise that this is tricky. Let's not pretend that trying to understand the financial risks or the financial implications associated with climate change is a straightforward exercise, nor that measuring and defining and quantifying impact is a particularly straightforward exercise. And I can say, from our point of view, we've spent a huge amount of time over the last 5 years developing measures of climate risk exposure, whether that be through carbon prices or physical risk, a huge amount of time quantifying social impact in a way that can be used alongside financial measures of risk and return through an externalities model, SustainX, that we've developed. But all of these are essentially, none of these are perfect. We are simply trying to find a better way of answering what's a very difficult question. And the need to create more innovation, more of our industry focusing on trying to understand those questions, put them into terms that can be looked at alongside conventional financial inputs, like risk and return, typically measured in dollars, and to put things into the same language onto the same page, and then to start being able to look at these things together, rather than simply thinking about, as is too often the case, social outcomes as being somehow a sort of separate topic or an add-on to the investment process. I think it is absolutely vital, and we are starting to see that, but it is challenging, and it's not just about kind of will. It's also about ensuring that our industry collectively tries to innovate in how we think about what investment is and how we think about measuring investment outcomes and defining investment risk in a way that we haven't, frankly, fully tackled yet, I don't think.
Great. Thank you all for your comments, Matt. I think that was really, really interesting. One thing that sort of struck me while you've all been talking, and I'll probably go to Andy first on this one because I've managed to leave you last on both the first questions. So I guess ready yourself. Imagine that we're doing this panel in 2030, and what kind of metric would you consider a success? Is it that a sort of slice of the $50 trillion that we sort of say might be available to go into emerging markets? Is it that a large slice is there? Is it that the stat that Daniel talked about, that $1 invested in France is sort of 7 times less powerful than one in India? If that margin is halved, would that be considered a success? Is it this sort of idea of standardization? And, if there are stock exchanges for, various green investments, is that something that you would, I guess it's hard to achieve a goal without sort of knowing what you're shooting for, and what would you want to see 10 years down the line, say? I'll go to Andy first, as mentioned.
I would start from the end of the process, which would be to say that ultimately the goal here has to be figuring out how can we close the shortfall between the capital that's needed to be invested in those solutions and the amounts that are currently being invested, particularly in emerging markets where that shortfall is significant. And so as an ultimate outcome, if we reach that point, if we reach a point where capital availability and capital need at a societal level are aligned much more than they are at the moment, that will define success. The question, therefore, in a way, becomes what does that look like in practice? And I actually think the only way we're going to get to that point, given the scale of numbers that we're talking about and given the scale of the challenges, is actually that the entirety of the finance industry, where the opportunities are, where the returns are coming from, are aligned to where societal needs are greatest to a much greater degree than they are at the moment. In the end, treating this as being something which is something that we need to do, something which we ought to do, will get us so far. And clearly, I think everyone on this call is clearly trying to figure out how can we try and close that gap. But ultimately, it's a confluence of policy measures. It's a confluence of its sort of industrial policy, multilateral organisations, and kind of international organisations in terms of their ability to de-risk things, as well as private capital, all essentially pulling in the same direction, such that policy measures and policy incentives, and therefore economic incentives and financial incentives, are all aligned in the same place. And that we don't have to think about this in terms of how can we align, close this gap in the same way. The gap will essentially be closed because the question of trade-offs, the question of reallocating capital in different places, because and the sort of financial or investment questions that might create will have been resolved by the fact that we'll have everyone on the same page. And I think we similarly have to think about this not just in terms of what can the finance industry do, but the finance industry can move huge amounts of capital where there's an economic return to doing so. It can move very small amounts of capital, frankly, in the scheme of things, where there is a will to do so, but not a perceived economic return from doing so. And it's about shifting all of these agents together. All of these actors in the system together can potentially unleash huge amounts of capital flow in short spaces of time, but it won't be any one group in isolation.
Let me build perhaps on that and say, if we were sitting here in 2030, I'd like to see that maybe half of the portfolio of the international financial institutions, like the World Bank, the Asian Development Bank, the Latin American Bank, the African Development Bank, half their portfolio is going to mitigate and to fight climate change and climate risk. That would be one indicator. Why is that? Because initially, we need to understand, again, this is a public good, and we need to deal with externalities. The private sector cannot easily deal with externalities. Number two, we're talking about long gestation projects, particularly when we're talking about infrastructure. So we're talking typically 10, 15 years, 20 years ahead. Again, the private sector is difficult unless you create the right incentives for the private sector to do that. So the development banks have got to be doing things differently than what they've been doing so far. They've got to go back to their origin. If you think about it, right after the Second World War, we created the Bretton Woods institutions because we had to rebuild a post-war economy, and we realized that much of the world needed development. So that was the reason why we set up most of these institutions. We now need to reorient those institutions because climate change is an existential risk for everybody, but particularly for the emerging markets. If you look at any assessment of climate-related risks, they say that something like 20 to 25% of countries around the world run a potential collapse of their ecosystem very soon. I mean, it could be as soon as maybe 15, 20 years from now. So it means we need to act quickly. So to come back as to what indicator I would look at, I would say at least half of the portfolios, investment portfolios and lending portfolios of development institutions, and I think offhand, maybe 30 to 40% of stock market and market finance would be climate related in one form or another. And that means we should have integrated climate risk and the pricing of climate risk across the whole supply chain. And therefore, the markets then understand what they need to do. If you don't have the pricing right, the market won't be able to do so.
Maybe I can jump in, Alice. I think, we settled on 2030 goals with our shareholders as part of a historic capital increase that we agreed on in 2018. That we're bringing in about $5.5 billion in capital, which is triple what we had at the beginning and the first capital increase we've had in about over 20 years, largely because we've been able to actually create financial returns through our emerging markets investments that allowed us to support ourselves through retained earnings. But when we look to 2030, one of the most important things we see is to really start working in the poorest countries, because we see that as a huge role for IFC. And because when we look at these countries, they don't have the fiscal space to borrow a significant amount of money at this stage to solve the problems themselves. So where they need help is for the World Bank Group and IFC to start bringing in the private sector in areas where we have data and evidence globally that there can be a market solution if the policy reforms are there, if the standards are there, and if we can start to mobilize the capital, as Andy was saying, from the $1 trillion that are in the market. And I think what's interesting is the returns have demonstrated in these markets, as I mentioned, that if they're structured well, and if we invest into the right vehicles in the right reform environments, that the returns can be beyond adequate, while at the same time as solving these challenges. So for us, we're really looking at doubling the amount of investment we do, including the mobilization that we do from other investors, and then putting 40% of that financing into the lowest income countries and to fragile and conflict affected countries. And then putting 35% of our own account investment into climate related investments, and quadrupling what we do for women-owned businesses. And this is really around this idea of building back more resiliently. And I think when we look at this concept that came up about really investing in the real world or real sectors, a good example is what we've been trying to do in renewable energy in Africa, which is around sort of creating this market for the private sector to come into a sector which seems natural in a place that has a huge solar resource. But when you look at de-risking the project, it starts from, what is the tariff policy? Who is the off-taker, and are they bankable? Would someone take the credit of the off-taker? How do you get land in many of these countries in a way that will allow investors to go in without taking on that additional risk? And so we first worked in Zambia and created, with the World Bank and with our political risk insurance arm, MIGA, a project to bid out a solar concession. And that ended up going to Enel of Italy and really coming in at an affordable price for the country. Now we've been working in Madagascar and Senegal and Cote d'Ivoire. We're talking to countries in Asia now, and I think there's a real opportunity, but we have to look at the full component of what de-risking means. And I think mobilizing the money is really important, but then but there's a lot of money. So if we could actually figure out where to put the money sustainably to solve the problems, that's where we see our biggest role looking forward, is really creating these pipelines of bankable projects looking forward, so the private sector can play a role alongside of government to solve the challenges in these countries.
I mean, maybe just to add another perspective to this.
If I may jump in. Sorry. So you go ahead this time. Sorry.
Okay. Thank you very much. I was going to say, I think I agree with everything that the panel has said, which is I guess, slightly worrying that we're all somewhat agreeing with each other. But maybe just to bring a different perspective on this as well and come back to the science a little bit. So focusing just on climate, we need to see a significant drop in emissions over the next decade. I think it's up to an estimate of 55% change in emissions over the next, effectively, 9 years. And that's going to be a significant change. And I think particularly, as Nasser and others have said, in emerging markets where there's high populations, relatively low emissions per capita at this stage, that also means changing the way that development has run and growth has traditionally been done, taking the carbon out of the system. So the one metric that I think we haven't talked about is the carbon price. And I think this is really important. We don't really have a proper way of benchmarking carbon pricing at the moment. And I think, again, World Bank research, I think, says on average, world carbon prices sort of at around $4 or $5 per ton, and they need to be at sort of $75 per ton to really see the level of change that is happening. So I think how we start thinking about bringing in a much more clarity around the kind of emission content and effectively removing that carbon from the system is key. And I think some of that we've already touched on. So in the power sector, effectively, we need to move to clean technology. In other areas where you can use electricity as a source and then use renewables for that electricity, you need to. And then we need to start thinking about the harder to abate sectors, like things like the manufacturing of steel and aluminium, which just between those two generate 3 times the amount of emission that the entire mining industry does globally. And here, I think the one thing we haven't mentioned is offsets. So I think ideally you want carbon out of the system, but then when you can't do that in these hard to abate sectors, at least in the short to medium term, we need to think about how you are offsetting that carbon impact through nature-based solutions or others. And we've been involved in working through something called the Task Force for Scaling Voluntary Carbon Markets, where we think the private sector can play a role in this with 50 other institutions, and many on this call as well, and other corporates, and to see how we can create credible, transparent, and deep markets for these carbon offsets. But then also, by proxy, will provide effectively a market discovery carbon price, which then I think will be an important tool to everything else that's just been discussed by the panel.
I'll add to that, Daniel. I fully agree. And there was a point I wanted to touch on. I think, first of all, I'll go back to what Nasser was saying about the role of regulators, central banks, etc. And I fully agree. If we just take the example of how much sustainable investing has grown and is central everywhere in Europe now, it's no surprise that you see associated with that the EU Commission and all the countries having their own rules about, if you want to call something sustainable, it has to respect a number of characteristics, and also the encouragement, the action plan, etc. So where there is strong regulation, we accelerate on the path of sustainability. So the UK is focused on that too. I think next, we know in Asia, in Singapore and Hong Kong, there's already kind of a classic rivalry, and also leading to be the leaders in sustainability in that region. So I think without that, there are no rules of the game. And as was said earlier, if you don't have metrics and sort of disclosures and rules, then asset managers and investors are not pushed and have to make a trade-off, have to make a compromise potentially. And when you go into countries like the US, where fiduciary and return is first, it's hard to weave it in. So regulations very much needed. So in 2030, as back to your question, Alice, given the new administration in the US, given the evolution of China and the rest of, I would hope that we have a much more developed regulatory approach to sustainability globally, because that will accelerate the flow of capital. Second, I think I would want to see, yes, the carbon price, I was about to mention it, should be much higher, right? Because it is a transition between now and 2050, where we should not need carbon offsets in 2050, ideally, right? Most industries should have transitioned. But today, one metric I would like to see is that in 2030, the global public equities market 5-degree trajectory, but is now on a 2.5-degree trajectory. But to get there, you need some companies to completely decarbonize and others to actually embrace carbon offsets and use them as part of their way to be net zero aligned. From 2030 then to 2050, we should hopefully get to 1.5 and then not need carbon offsets. The third point I would like to make is about private assets. And I think private assets are on a different time scale. And bizarrely, to me, they are on a much faster time scale. This morning, we were talking with our CIO of private investments. And basically, it's today. Whatever checks they cut today to buy into a project, if they don't anticipate sustainability and climate impact, in 10 years' time, when they want to sell out of that project, the project is worth nothing, right? So they need to embrace sustainability today. And the sort of rigor on funding private projects today is much higher from a sustainability standpoint. So I would think that regarding private assets, I'm not going to answer the 2030 question, but I'm going to answer more like a 2022, 2024 question, which is most of private asset investing should be aligned with climate objective and SDG objectives.
Wonderful. Well, I think we are starting to run out of time a little, so I'm just going to take one question from the audience, and I ask that my panelists keep it brief, but time flies when you have five such well-versed participants. So we'll just do one question from Miriam at EcoValue. She says she understands the need to prioritize and focus. However, is there a risk of cherry picking the social development goals? How do firms ensure that SDGs are addressed in the most relevant term in terms of their impact in a particular sector? I don't know if that jumps out at anyone. I can pick someone if not.
Maybe I can just jump in quickly, because we've developed an impact measurement system, which we call AIM, which is really trying to anticipate upfront what the impact of a project will be, and then have an impact score plus a potential financial return. So when we make strategic decisions, we're deciding based on what the potential impact will be in addition to what the potential financial return will be. Our staff are a lot of investment professionals, and using these two quantitative measures has helped us really to drive both for impact and for return. And then when we look at the country level, just quickly, we're coming up with what we call country private sector diagnostics, looking at where could the private sector play the highest impact role across the country, and then trying to direct our reform efforts and our development of projects, and then our ultimately de-risking and bringing in, mobilizing money into those sectors where it will have the highest impact. And then, as I mentioned earlier, we're trying to work with 40% of our financing actually going into lowest income countries, taking into account our private sector focus, and then also what our impact measurements tell us. So that's how we try to do it at IFC, and we look forward to mobilizing my fellow panelists to invest alongside of us. Thanks.
I mean, maybe just briefly to add to Karen. So I think the key thing, I think implicit in the question around cherry picking is really around the transparency of impact, is making sure that when capital is directed to an SDG, that it is truly actually having a positive impact that would otherwise have not happened. And I think that's why our framework that we've identified that links our activity to the SDGs and then the impact report that we show is really critical. And I mean, the report that we just put out shows that 91% of our assets that we've aligned to the SDGs are in emerging markets, and actually 86% of those are in sort of low to middle income countries that really need it. So I think that's the kind of transparency I think investors are increasingly going to want to show that their capital at work is having the knock-on impact. And if we can do more of that, then I'm sure that in itself will catalyze much more interest as well.
Can I be a little bit maybe out of the box and say, I think we need to revise the SDGs? When you think about the work that went into the SDGs, that was done some 20 years ago or thereabouts, before we came up with the SDGs and even on earlier data. Climate risk and climate change is now a present danger that was not present at that time. So I would say you need to review your SDGs entirely. We need to put climate risk as the top SDG, because if we don't deal with climate risk, you can forget all the other SDGs, whether it's in terms of gender, whether it's in terms of economic development, anything else. And I think sustainability, I think we need to forget about sustainability. And instead of talking about sustainability, let's start talking about climate finance from now on, not sustainable finance, because there won't be anything to sustain. And so let me just be provocative from that point of view. So I don't think it's a matter of cherry picking any longer. Your priority has to be dealing with climate change, and it's pervasive. It affects simply all sectors and all human as well as animal activities, which we tend to forget. So I would say change your SDGs. I think we need to go back to the drawing board.
Great.
I'll react to that because Nasser, sorry, I was going to say something similar. Yeah, very quickly. I was going to say, yes, urgency is climate. Number one, no debate to me. But I wouldn't go as far as you say, and I would say the other SDGs still matter. As a top priority, strategically address climate, but let's not completely forget about no hunger, no poverty. They are important, and I'm sure you didn't mean the opposite.
Agree.
I'm with you. Climate is first.
Except the climate will make the hunger much worse.
Yeah, agreed.
Right. I might call time on our panel. Then I don't want to keep you all longer than we'd agreed. Interesting that our sort of first ripples of disagreement came right at the end of the panel there. But I think, some of the interesting sort of points that have been raised, there certainly are a lot of tools through which we can sort of tackle this question of getting capital into sustainable projects in emerging markets. The question is sort of whether we can ramp those up fast enough, and certainly, urgency, as was repeated at the end, is clear. So I thank the sort of questions that came in. I'm sorry that we didn't manage to get to many of them, but thank you to everyone who participated in the panel, and thank you very much to my panelists for joining us today. It was a real pleasure discussing this topic with you.
Thank you.
Thank you very much.
Thank you.
Thank you.